Hi everyone, welcome to Paper 2, the preview for 2024. Hopefully you found Paper 1 useful, hopefully this one can be just as useful. So in this video we're going to do a few of the same bits that we did in Paper 1. I'm going to go through them in a lot less depth because if you want to see some of those bits like the exam question structure in a bit more detail, you can go back to the Paper 1 video. I'll put a link to that in the description, and just to save you, for anyone who's watched the first one, having to watch the same thing again. But I will very briefly recap it for the benefit of anyone who, to be honest, it's never a bad idea to have another recap, and for the benefit of anyone who maybe didn't listen to that one. I'm gonna run through some of those bits quickly at the top. The timings for everything's in the description, so if you want to skip ahead to certain bits, then you can. I've added in a few little bits here. I've added in a bit about calculations from previous years, which was something I did in my class before Paper 1 that I thought was actually quite useful, so I've added that into the video. And then in the key links between themes 2 and 3, I've added quite a bit in there. So certainly if you're looking for things, if you watch Paper 1 video and you're looking for things that are really, really different, I would skip ahead to the calculation from previous years and topic tracker from previous years, because that's when it's going to be specific to this paper. So Paper 2 basics, it is the same as Paper 1 in the sense that it's 2 sections, 1 hour each. 4, 4, 10, 12, 20, 4, 4, 10, 12, 20. So make sure you get your timing right. You've had some practice with Paper 1, so you should know what to expect. There's no need to go into that more detail. You get the same, you get 2 set of extracts, one for each section. One little difference between Paper 1 and Paper 2 is Paper 1 typically tends to be primarily Theme 1 in the first section and then Theme 4 in the second section, or more of Theme 4 in the second section. It's not really like that in Paper 2. It seems like it's a bit more, Theme 2 and 3 actually have a lot more closer links together, and a lot of topics come up more than once. So it's you shouldn't expect to see Theme 2 one section, Theme 3 the other. But approach those case studies carefully. In terms of structure, same structure. You won't get a construct question in this. You won't get a graph to draw because there's no supply and demand curves in Themes 2 and 3. But you will probably get some calculation questions, and the calculation questions will probably be quite a bit more varied. So show your work and make sure you're clear on the units in your answer. For our 4 markers, we need 2 bits of application. 10 and 12 markers. A couple of comments in the last video, in the Paper 1 video about this. My advice is, look, if you can do 2 peach paragraphs and you can do that in time, that's fantastic. Like, you're not going to be hurting yourself by writing more. But timing is an issue. Timing's really, really difficult. The 10 and 12 markers is where the timing's the most tricky. And so as long as you've got balance in your peach paragraph and you maybe had a bit more depth in your however, then you should be fine. 20 markers, we want 2 peach paragraphs, 1 for option 1, 1 for option 2, and then the conclusion we're using the AGM. Again, look to the business, focus on the business in the question. In this situation, you probably will see something about increasing profit, because profit is a common theme throughout themes 2 and 3. Conclusions, again, I talked about this in the first video, but make sure you make your choice clear. Justify the main reason for your decision. That might be where you might compare it to something else. Adding it depends on if you can mitigate for one of the negatives you offered, and then think about MOPS for the business. In this situation, you're probably going to be thinking a lot more about the finance side of things, a lot more money related and strategy related. So objectives and strategy can come up quite a lot in Theme 3, and so that might be an area you could use in your conclusion. And but again, we've gone through those things. If you want a bit more depth on that, which would be a good idea, especially if you didn't watch the Paper 1 video, go and have a look at the Paper 1 video. The link's in the description. So Theme 2, exam content. Theme 2 and 3. There's a lot of maths in this. There's a lot of calculations in here. However, what I would say is that obviously the numerical assessment is usually only about 10%. So you might only get the 2 4 markers or 3 and 4 markers on this that are actual calculation questions. And so I say to students all the time when it comes to the numbers, it's not really about the numbers. It's about the understanding of the words that the numbers represent. And if you understand those things, you're in a really, really good place. So we've got raising finance, financial planning, managing finance, resource management, and external influence. It's basically finance and operations, and then a bit about external influences on the end. And then Theme 3. I think Theme 3 is probably my favorite theme. Do you have a favorite theme? I don't know. I've been teaching it a long time, so maybe I should have a favorite theme by now. Because it's all about strategy. It's all about what actually businesses do. I feel like Theme 1 and 2 introduce the course and introduce what a business is, and Theme 3 is where you probably start to study what like a business actually does in terms of like proper strategy. 3.3 and 3.5 in particular, where you see the maths side of things, we're going to come back to that later. So case studies, same bit of advice I would give you is look at the case studies and look at the questions first. work through the case studies, knowing what the questions are, so that you can annotate the case study for purpose. I looked at a couple of my students' extracts, and there's quite a lot of annotations around that, and so I'm really pleased that people have been doing that. Hopefully you find it useful, but it does need a bit of practice. So if you've not tried this before, I wouldn't advise trying this for the first time in the exam. I would recommend getting a past paper from online and practicing this. Even if you don't fully write all the answers out, you can plan them, and you can practice the skill of this case study stuff. So tips for success, the same 4 apply: timing, application, structure, and knowledge. If you get those 4 things right, you should be in a really good place for this exam. Make sure you got your timing right for all of the questions. I mentioned about the 10 and 12 markers being really important for that. Make sure you use the case study consistently. Make sure your answers have got balance. Make sure you've got conclusions where you need conclusions. And make sure you know your key terms and focus on your key terms. To help you with that, I've put a link to a Theme 2 and Theme 3 Quizlet set in the description. So there's some stuff in there that will help you do that. Right, this is the new stuff. So to anyone who's just joining this video, to be fair, I went through it really, really quick. So you're not joining it very far through. Possible calculations. Now, I didn't do this in paper 1, and I wish I had now in retrospect, because I looked at it kind of after recording the video, and there was a few interesting things that I thought were worth pointing out. Here are the types of topics. There's loads. Here's the type of topics that might see calculation-based questions from paper 2, so from themes 2 and 3. So I've put these in these different unit sections. If you want to recap on those units, the recap videos are linked in the description. So there's already recaps on these. However, later on, especially for some of the calculations, I will put some of them into the end of this video. So you'll be able to see, like, for example, all the profit margins and the ratio analysis stuff. 2.1 has got a bit about interest repayments. When you're thinking about, like, I wouldn't expect it, but like I wouldn't rule it out either, because there's a bit of economic stuff on there. When you're thinking about bank loans, cash flow forecasts as well could potentially be one. For 2.2, moving average, sales, revenue, costs, break even, margin of safety, variance. There's a whole range of calculations in there. Obviously, it's the finance units there's going to be. For 2.3, all of these come back later in 3.5. So gross operating and net profit margins, and just gross operating and net profit, current and asset test ratios, working capital. For 2.4, these come up a little bit later on as well. Productivity, labor productivity, capacity utilization. 2.5, it might be interpreting data from the economy, exchange rates, interest rates, inflation. And then in 3.3 is where we start getting the series, the heavy stuff. So moving averages, which I teach it in 2.2, but it really is, the concept of sales forecasting is taught more in 2.2, but the calculation side of it is taught in 3.3. I tend to teach it in 2.2 as well, so that when we do it in 3.3, we're kind of recapping it rather than learn it from scratch. But investment appraisal, payback period, average rate of return, net present value, decision trees, critical path analysis. 3.5 is all of the stuff that was in 2.3, plus return on capital employed, gearing ratio, labour productivity, absenteeism, and labour turnover come up in the HR stuff. So there's a few things that's worth bearing in mind. That looks like a really intense list, and it is. There's a lot of calculations there. But actually, some of them are repeated. So all the 2.3 profitability and liquidity calculations, they all appear in ratio analysis. So if you're revising ratio analysis, you're revising those are the ones. Sales forecasting appears both times, as I've already mentioned. I teach it maybe a little bit of a different way. And the 2.4 calculations on managing staff, measuring staff, they also appear in the human resources. So there's a bit of turnover there. But let's have a look at what's come up in previous years. So these are the calculations that we've seen over the last several years. So you can see there, to be honest, I wouldn't look at a pattern for this, because there's so many different calculations. You can see, how frequently each one has come up. So asset test ratio, critical path analysis. It's interesting that critical path analysis hasn't come up that frequently on paper 2. Decision trees have only come up once as well. Ratio analysis has come up a bunch of times. You've seen gross profit margin, ratio analysis, operating profit margin, asset test ratio. So I would definitely be looking at the ratio analysis. We've seen a bit of break even in there twice. We've seen contribution per unit. 3 times actually. We've seen margin of safety and break even. So I guess the key thing, what do you want me to say? Like, revise all the calculations, because you don't know which ones are going to come up, because there's so many that could come up. And so, but I guess what I would say is, don't just blindly revise the calculations. Try and have an understanding of like what they actually mean. So topics in previous years. I've went through this, same as I did in paper 1. Again, I don't think there's too many conclusions you can draw. Some of these topics you might notice haven't come up. So like sales revenue and costs, 2.2.2, like those things have come up, but in different ways. So, for example, that's kind of an introduction to the profit stuff you do later on, and so you're going to get assessed on the harder stuff rather than the sales revenue and cost bits. I think liability as well. Liability is mentioned, and it comes up, but it comes up in like forms of business and business ownership rather than coming up in liability. And I think that in the international A level, they've moved the forms of business into the raising finance section, which I think actually makes a lot more sense. But I guess what I would look at is like profit and liquidity comes up all the time, right? You can see in papers 2 and 3, it comes up a bunch of times. Liquidity, like liquidity based sections, came up 3 times in 2022. You can see that these things come quite a lot. We've seen a bit of everything really. We haven't seen quality for a while. We haven't seen quality management since 2019. Maybe something worth having a look at. We haven't seen a huge amount on the competitive environment, but it's not a massive topic. We've seen quite a bit on the economy every kind of year or two. Those would be the things I'll be having a look at. But again, as I say, we don't really do predictions because, maybe one thing that's worth having a look at is we haven't seen sources of finance in the last 2 years, and yet before that we'd seen it in 4 or 5 years, and quite frequently in that. So maybe we're due a return for sources of finance. For theme 3, the really big one to pick out is that theories of corporate strategy has come up every year. Not necessarily in like a question that's really obvious that it's from theories of corporate strategy, but it like something related to that comes up every single year. So that's definitely one I would have a look at. Those, they're in the video later on. External influences have come up the last 2 years, but they weren't assessed before, so that was something we thought might come up a couple of years ago and did. Corporate influences hasn't come up, but that's because corporate influences will be really closely linked to corporate objectives, which has come up a few times. We haven't seen culture for a while. We haven't seen culture for the last 3 years, and I quite like a question on culture. Looking at 3.6, I wouldn't look too much into the fact that they haven't come up for a while, because causes and effects of change and key factors of change, it's kind of like a recap unit for the entire... I'm going to talk about this later on as well, but it's kind of a recap unit for the entire theme. So while causes and effects of change and key factors and change haven't come up, those things are hinted at when you think about things like takeovers and mergers, because those will lead to change in a business. So they've come up as well. But again, I wouldn't look too much into it. It's just quite interesting. I mean, the one thing that I would say you would very much expect to see in one of the questions is theories of corporate strategy, because it's come up every single year. Other than that, I think you can kind of lead yourself down to a narrower path. Right, links between themes 2 and 3. So we're going to go through a bunch here. We're going to look at raising finance. These are trying to find like the connections between the stuff that comes up in theme 2 and the stuff that comes up in theme 3. So we've got raising finance, profitability and liquidity. We'll look at the numbers and the calculations there. We've got a bit about external influences. We've got the strategic theories, which is that 3.1.2 I just mentioned. And then we've got a bit about change and how change... I mentioned change was the recap. I'm going to do it as the recap of this video. So let's get started. Finance, use of finance. I guess the key thing is that the sources of finance are used for different things within a business. And so mainly they're used to expand and grow the business. And so we can link use of finance and sources of finance to the different ways we grow. So which source of finance, for example, are going to be most suitable for the business? It's not enough to just know the different sources of finance. It's well worth knowing what the benefits and the drawbacks to each of those are. And you've got to consider the business in the case study. What's their cash position? How much debt do they currently have? We're going to talk about gearing later. What's their type of ownership? Like, are they a PLC? Can they raise share capital? Are they willing to lose a bit of control if they're a limited company? Are they an unlimited company, in which case they might not be able to access certain sources of finance? And then what can this lead to? It can lead to organic growth, where the business grows through its own actions, like opening new stores, creating new product lines, or it could be where they do a takeover or a merger. So if you, instead of saying growth, mention like the organic, you can create those links in your answers. So let's go through in a bit more detail. Let's talk about that capital employed a little bit, and then some of these calculations we're going to come back to later on, but we can link this. Like loan capital, for example, one of our sources of finance, we have to consider how much loan capital the business already has. We think about their gearing. So just to introduce this concept of capital employed, we're going to touch on capital employed a little bit later, but I want to introduce it properly here. Capital employed is all of the finance used by the business with the aim of making a profit. And this finance comes from two sources. It comes from within the business, our internal finance. So they're people like who own the business. So the share capital, retained profit, the total equity basically. And it comes from the external finance, which is the money we get from external. So outside borrowing, non-current liabilities like the long-term loans. And if you add those two things together, you get the total finance available, and that is what we call our capital employed. So total equity plus non-current liabilities, basically internal finance plus external finance equals total finance, capital employed. And you use this, the reason we mention this is because we use this in two really key calculations. We use it in ROCE, or I tutor a student and he called it ROCA. I've always called it ROCE. If you know which is the right pronunciation of ROCE or ROCA, please do let me know. But I've been saying ROCE for a long time. I guess like I just maybe heard one person say it and assumed they were right, and I've never really questioned it. Maybe I should question it. Maybe I should question more things. ROCE, operating profit over capital employed times 100, and then gearing is non-current liabilities over capital employed times 100. ROCE is how much of our capital employed, how much of our total finance invested have we returned as profit. Gearing is how much of that total finance is the debt finance. So the higher that percentage, it means the more the business relies on debt. Not necessarily a bad thing if they can pay off the debt, but obviously comes with its risks. So loan capital can impact on a few of these calculations. So there's one link between the stuff that's done in Theme 2 and Theme 3 and different topics. Let's stick to those finance bits though. You can't hide it, unfortunately, fortunately if you enjoy the math side of things, unfortunately if you don't find that stuff the easiest. Profitability and liquidity come up in Theme 2 in 2.3, and then they come up again in 3.5. Profitability is the main measure of success of a strategy. It determines how well any strategy's gone. It's important to the shareholders because they're going to get their dividends from the profit, and it can create profit that allows reinvestment in the future. And in the long term, your profit as a business should be enough to allow you to continue to operate. In the short term, with a small business, you probably don't necessarily make a profit straight away. So in that situation, liquidity is more important. Liquidity is about how much cash you've got. So that will determine how you're able to make certain decisions. Do you have cash? Will you require external finance? Obviously, cash flow is not just about the revenue we get. It's about the cash we can generate. So we could get loan capital. That's not a revenue, but it is a cash inflow. We could get, credit sales would show in revenue, but they're not necessarily going to be cash straight away. And then be considerate of how we measure our working capital, current assets and current liabilities. Like how do we manage that day-to-day cash spending? The understanding of working capital has generally been quite poor on assessments, and so it's something that there was a period of time where I used to get asked about all the time because the exam board wanted to ensure that students were learning it effectively. So definitely worth making sure you're familiar with the concept of working capital in case they test that again. Here are all of the calculations, and here is the two tables that you would get these from. These tables are in full depth. You wouldn't necessarily get this much depth in the exam. You would just get the information you needed and maybe a little bit more to try and throw you off the scent. So be aware that what you see in the exam won't be necessarily as detailed as this. I haven't taken these numbers from a particular business. I've given no real thought to the numbers other than just put random numbers. Because that's not really the point of this. The point is just to be able to do the calculation practices. So you've got the statement of financial position, which is our assets and our liabilities and our total equity. And then on our top right corner, we've got our income statement, which is our revenue, and then our different levels of costs. So gross profit, operating profit, and net profit. In the middle, I've put all the calculations. So gross profit margin, operating profit margin, and net profit margin are the same calculation. Net profit, gross profit, operating profit over revenue times by 100. That shows how much of your revenue as a percentage has the business kept as gross operating or net profit. Return on capital employed uses capital employed. We talked about that earlier. So return on capital employed is operating profit over capital employed times 100. The gearing ratio in the bottom right corner, that's the other one, which we talked about earlier. Non-current liabilities times by 100 non-current liabilities divided by capital employed times by 100 tells us how much of our money comes from debt. On the balance sheet, so the statement of financial position, we can also carry out a calculation of our current ratio and our asset test. We can also calculate using our statement of financial position, our current ratio and our asset test ratio. So current ratio is current assets over current liabilities. It's basically how many current assets do you have relative to your current liabilities. That's going to determine your current assets are what you're going to turn into cash in the next 12 months, if it's not already cash. So the more of them you have compared to your current liabilities, which are the things you're going to pay in the next 12 months, the more likely it is you're going to have enough cash to pay your bills. The asset test ratio just makes that a little bit more specific. It takes away inventories. It takes out stock from that equation because, frankly, sometimes inventories aren't reliably able to be sold. So, for example, if they go out of trend or they become obsolete or they become out of fashion, or they are perishable, like if it's a food product, then you might not sell those. So it takes those away and then looks at like what we call the highly liquid assets and whether there's enough of those to still pay the current liabilities. What I would recommend now is pausing the video and then doing the calculations, filling in the tables, draw the tables and fill them in, and then calculate the answers and see what you get. And then if you click play again, the answers will appear on the screen and you'll be able to just check whether you've got the calculations right. If you want to practice this, all you need to do is just change all the numbers in the table to different numbers, and you can practice it as many times as you want. So I'll leave it a few seconds, and then you can press play to see the rest. Right, how'd you do? Well, I hope I got them all right. Gross profit margin of 50%, operating profit margin of 17.57%, net profit margin of 8.78%. I wouldn't read too much into those numbers in terms of like what they mean at this stage, because not for this example, because I literally just made the numbers up. But what this represents, basically 50% gross profit margin means that this business, after they've paid off their cost of sales, the cost of making the products, they still have 50% of their revenue. After they've paid off their fixed overheads, they still have 17.57% of their revenue. And after they've paid off everything, they keep 8.78% of their revenue. So basically, for every pound of revenue they get, after all the costs are paid, they keep 8p and 8.78 pence, which isn't a real thing, but you get the idea. Return on capital employed is 13.27%, so they get 13% of their total finance invested, the £980,000, back as profit in that year. So obviously, that's quite a high figure. Their current ratio is really high, 3.4 to 1. That means for every £1 of current liabilities, they've got £3.40 worth of current assets. That should suggest that they will have no problem meeting cash payments because they've got way more. In fact, that's actually higher than you'd want, really. It suggests they're being quite inefficient with some of their assets, and they could be using that to maybe potentially further invest in their business. Even when you take away the stock, they're still at 2.33, which is quite high. And then the final one, the gearing ratio, is 24.49%, so just short of 25%. Basically meaning that about 24.49% of their finance they're using comes from long-term debt. So the rest obviously comes from that internal finance we mentioned earlier. So hopefully you did quite well with those. Just good to get some practice of those before the exam. Let's move on to some of the non-financial stuff now then. So the economy. The economy is mentioned at the end, is studied at the end of theme 2, but it links to so many different theories of strategy. So the economy will affect the level of risk a business is willing or able to take. So if we think about Porter's generic strategies and his theory of competitive advantage, it's just a good one to link to. We've got the low-cost producers, where businesses keep costs low to keep prices low to try and gain their competitive advantage, or we've got high levels of differentiation, where they try and differentiate their products, maybe to set a slightly higher price or to gain a competitive advantage. The key thing that's worth bearing in mind is in the economy, if we are in a situation with our economy where people's incomes are stretched, they might switch more towards the low-cost producers. If the economy is doing pretty well, then we might see people stretch to more of the high differentiation products. They might be willing to spend a bit more. There is, of course, the mid-market as well, which is a little bit in the middle, but Porter didn't really like that part of the market because he felt like they were at risk of losing sales to either side. Another Porter theory, love a bit of Michael Porter. When I was at university, we used to have a lecturer who mentioned Michael Porter's name so frequently that we used to count during lectures, and we used to bet on it every week. And the person who got the closest to the number of times Porter was mentioned would win, would get a point. You get 3 points if you got it exactly. And at the end of the year, all the money that was in the pot went to the winner, the person who got them right over the whole year. This was my final year of university. I worked really hard, and I ended up winning. I ended up winning 60 quid because I guessed the right amount of porters more accurately than my friends. And we took the 60 quid. We went to the student union pub. I bought everyone a burger. We put the rest of the money on the pool table, and we just sat there after the last lecture for about 4 or 5 hours just playing pool. It was a great day. And so I've always had a fondness for Michael Porter's theories. And the reason that he was mentioned so frequently is because his theories are actually like really prominent within business. So Porter's 5 forces looks at the competitive environment. And what that looks at is 5 different external forces that impact on competition within a business. So the first is the rivalry amongst existing competitors. That can be a really fierce rivalry. There can be lots of competitors. It might be that there aren't that many, or they're not big rivals, really. One might be better than the other. It also looks at the threat of substitute products. So is there something else that might stop someone using that business's product? In which case that potentially could mean that it's going to be more difficult to compete because consumers have alternatives. Is there a threat of new entrants? Is it easy for new businesses to join the market? If it's easy for new businesses to set up in the market, like if it's cheap to set up, then that might mean that there's a little bit more threat. Like cafes, for example, there is, well, the one threat of substitute is you can just kind of make drinks at home or drink other things that aren't from coffee shops. The threat of new entrants is actually quite high because it's not that expensive to set up a cafe. So the threat of new entrants in that market is quite high, but in other markets where there's like high levels of machinery involved, it might be really difficult to be a new entrant. The bargaining power of suppliers and buyers is also really important as well. So for example, how much bargaining power do customers have? Is there a lot of competition? Can they potentially go elsewhere? For suppliers, if there's only one supplier that supplies a key ingredient or a key material, they are going to have a lot of control. Whereas if there is only one business buying these supplies and there are plenty of different suppliers that could get it, a product that maybe like a material that's quite easy to find, then the supplier will have very little bargaining power because a business could say, right, well, if you're not going to give us the right prices, we might go somewhere else. So it's definitely worth looking at external influences and being aware of Porter's 5 forces. The theories of strategy, I said these come up, like it comes up every year in one of these areas. Porter's generic strategies we've kind of touched on already, but I will touch on it again. Boston Matrix, but the main one is Ansoff's Matrix, really. So Porter's generic strategies was basically talking about the low cost, high differentiation we talked about earlier. Low cost where we're going for the low cost producer strategy, high differentiation where we're going for the high differentiation strategy. The only real difference between that arrow and Porter's generic strategies is Porter in this model, he differentiates between the mass market and the niche market. So what you would quite often find is, to be honest, you don't see a huge amount of focused low cost because it's quite difficult to make a cheap like niche market product. Usually you don't get the benefits of like economies of scale if it's niche market. What you quite often do see though is a lot of mass low cost, and you definitely see a lot of focused differentiation. So businesses that target a niche market will typically try and do it by being differentiated because they aren't going to be able to compete necessarily on cost, so they'll try and compete on service. So focus differentiation, you can look at like a question in what a business is doing in the case study and see if you can apply it to one of these theories. That's Porter's generic strategies. The Boston Matrix is about how much market share a product has and how much market growth there is in that market. And this is a product portfolio analysis tool. So you look at your range of products and you would make decisions about which ones you might decide to invest in. So for example, your star products, unsurprisingly, are the ones you want. High market share, high market growth. So these have got high market share, so they're successful within that market and the market's getting bigger. That's exactly what you want. These products, you are going to make sure they're going to be the ones that generate the most profits for you, and you're going to make sure you want to try and keep consumers aware of those. The problem child, or question mark, depending on where you read this, they have a low market share, but they're in a high growth market. So this could be for a few reasons. It could be that they are in a really highly competitive market, and so market share is quite nicely spread out. It could be that they are not the big brand name that other businesses might be. It could be that the product's just new, so it hasn't built much market share yet. You want to invest quite heavily in the problem child products because they potentially could become star products if you can build the market share. Of course, though, if they've got a really low market share, there's a chance they might not be profitable, in which case you might decide to cut your losses. But if they're making a profit or you think they've got the potential to, you'll advertise those quite heavily. The cash cows, these are the ones that I guess you just milk the cash cow. They have high market share, so they're well established in the market, but the market isn't necessarily growing. And so these products probably just, I guess, generate consistent revenue. If it's low growth market, you might have less threat of competitors. And so you might feel like there's less to do in terms of advertising and aggressive advertising, but you will want to make sure people remember the product exists, remember that the product's there, remind people of its good qualities. So you'll do a bit of advertising. The dog product is the low market share, low market growth. Now, if a dog product is making a profit, you're probably not going to spend a huge amount of money on it. You're not going to invest heavily in it because it doesn't have the potential because the market growth and the market share is both low. But if it's making a profit, you're gonna stick with it. If it's not making a profit at this point, you would, and I hate to say it because I have a dog and I love my dog dearly, but you might put the dog down. I don't know if that's why it's called a dog product, but I mean, it makes sense, doesn't it? So that's the Boston Matrix. The Ansos matrix, this I think is in my opinion, the most significant theory, because I think it can just be applied to so many different situations. And so you might see, like, the question won't necessarily say Ansos matrix, and it's quite unlikely to say Ansos matrix, but it might mention like a 20 marker, for example, with 2 of these options. So they're maybe looking at going into a new market, they're looking at launching a new product, you've got to choose between the 2. Well, that's market development versus product development. So the idea here is we're looking at whether we're looking at our existing product or a new product, and whether we're looking at the existing market or a new market. The idea here is the further away we go from what we already do, the riskier it becomes. So existing product, current market is market penetration, just trying to get more strength within the market using the existing product. A little bit riskier than that is launching a new product. So this could be, like, for example, this could be a developed product, it could be an innovated product, it could be a sequel product. Your chances are you have a pretty good idea this is going to be successful because you already target that market, you already know the customers. So it's not that risky, but again, obviously there's risk with any new decision a business makes. Market development's a bit riskier because although you're taking an existing product into a new market, and so you know the product, you don't know the market, and markets can be quite drastically different. So you might find that, like, taking it to a different country or finding a new use for it might not appeal to those consumers in the way you thought it would. So that's going to be a bit more risky. Diversification is the biggest risk, right? But it can also potentially be the biggest reward. So this is where a business does something completely new. New product, new market. There's been loads of really successful examples. Apple's a really good example for this because you can fill all the boxes in with Apple. Market penetration is just any time they put a sale or an advertisement campaign together for one of their existing products. Product development could be any new iPhone. They're on, like, I don't know which one they're on now, 16, 17. Like, the newest one is going to be the next product development. Market development, there's been plenty of examples where they have taken their products into different countries. They've expanded globally. So that would be market development. And then diversification, they've done so many times, they've brought out a new innovative range of products. So the first time they did the iPod, the first time they did the iPad, the first time they did the iPhone in 2007, all those are examples of diversification. That model, I think, is really, really important because you can link it to so many different parts of the course. So well worth making sure you know Ansos matrix. And look, if it's a question about launching in a new market or launching a new product and you don't mention market development and product development, you can still get a good answer, but you should be able to bring those in. And so I'd recommend doing so. Right, the last bit here, change, an overriding topic in Theme 3. This is the recap unit, really. It just kind of shows that all of Theme 3 is about making key decisions for businesses, and that leads to change, and change is both positive and negative. So all of these are different examples of change. We've got internal and external growth. We've got leadership changes. We've got culture changes. We've got ethical perspective changes. All of those topics in Theme 3 can be linked to 3.6 change. We've got market changes like actions of competitors. We've got new technology. We've got Porter's 5 forces. So I guess the key thing to look out for in the case study is change within the business, because then you can start bringing in all these different parts of the course that you've looked at. Right, that's paper 2 previewed. There's obviously a ton of revision resources on the channel for this already. If you've got any specific questions, please do put them in the comments. My plan for paper 3 is going to be a bigger video because it's going to be very heavily research based. My plan is to try and get that up the first weekend of half term. I'm going to try and do it a bit that weekend. So for anyone who's thinking about asking about paper 3 video, there will be one. It'll probably be about then. Okay. If you've got any questions or if there's anything in particular you want me to have a look at, put them in the comments. I'll try and be as active in there as I can be, and to help you out. And then good luck.